Treasury yields saw a push higher today as demand subsided on some news that the president was making deals with Mexico, and that bled in some optimism about perhaps with China, and maybe things would be okay and we wouldn't have this cataclysmic end that everyone's been looking for with this flight to quality bid we've seen in treasuries and as of late gold, which hasn't really affected the stock market all that much. Stocks continue to push higher, but lo and behold, we did see Treasury yields push their highest of the month, or match their highest of the month of June. Right now, it doesn't feel like the end is near. It just feels like maybe we're at a stalling point. And I think at this point, you need to see yields get north of 2.25 in the 10-year bucket in order to begin talking about a reversal of momentum. That would be the 50% midpoint of the May 21st to the recent low range, and that would kind of give us maybe a little something to sink our teeth into. But I think that we saw a 6 basis point increase today in 10-year note yields. That's not enough. And certainly with the buying demand we've seen over the last several weeks, even you can go back to March really, but over the last several weeks specifically, it shows that there remains a very strong demand for treasuries. And we hit maybe a hiccup today on the news, waiting for some follow through with China that we never got. So Treasury yields a little bit higher. And what did that do to volatility? Well, volatility was a little bit softer. So we were trading close to 5% implied volatility in the 10-year bucket. When we hit those highs recently, we are now back closer to 4%, which is really more the norm. We spent a lot of time over the last several years hovering between 3.5% and 4.5%. So we're kind of right in the midpoint there. Nothing really to write home about. The fact that we've come off so quickly suggests that there really isn't a fear of pushing south of 2%. Likewise, I think positioners are squared up with the idea that if they were short or if they were on the wrong side of the trade, they're now long, and those that needed to own bonds now own them, so they can sit back, wait, and watch. And volatility has sort of come off as the market has sort of slowed its momentum down and reversed higher. So right now, volatility on the way down as yields go back up to the old range, or towards the old range, I should say. And lastly, we're going to look at what's going on, I think, in other places. If we look at what's happening with the Fed, the Fed right now remains on par for rate cuts later this year. Most likely not in June. We're going to see them cut in July, and then it's going to be a wait and see game, likely with another cut in September, possibly a 50 basis point cut in September. All things being equal, we don't know how that's going to play out yet. This morning, President Trump was on CNBC. He talked about what he wants with his trade deals, and he talked about what he wanted with the Fed, and it gave the market some positive momentum in the equity side. It kind of stalled trade in the bonds for a bit. We didn't see a whole lot of follow through. Yes, bond yields remained higher all day, but we didn't see any real major follow through push. So I think at this point right now, it becomes a wait and see game with how the Federal Reserve is going to deal with these new circumstances, or at least acknowledge the circumstances that have been there. As we saw just recently, the Fed acknowledged they were looking possibly to cut, but they would remain patient, but they will cut if have to. And that's something that the market has been pricing in for quite some time. So I think day one of the move back higher is nothing to write home about yet. We did see yields push as high as 214 today in the 10-year space from 206 last week, but I think at this point we need to see a consistent move higher. And again, that 2.25 yield is really going to be the line in the sand. You need to get back above that on a settlement basis in order to start to see momentum shift. Maybe we get back towards 230, 240, 250, who knows? But at this point, there is still very strong demand for bonds, albeit a bit lighter today, and 10-year note yields remain stubbornly low.